Hello, welcome to my channel. Today, I'm going to be trying to explain another of the institutional reference points, which is the mitigation block. Now, the mitigation block, I'm going to try to explain. Let me come here. It involves a movement that is something like this. Kudos to Michael Hudson and Solomon that tried to explain. Now, price will be moving in this manner. The price comes down, then the price moves up. But this high that the price is going to form is not going to be as high as the previous high here. Then price keeps moving down. Now, this candle here, which is the candle at this level, forms our mitigation candle. It gets broken, price comes to retest here, then price moves down. And that's what the mitigation block is about. Price, there's an uptrend, price comes down, there's a last green candle, there's a last red candle before the move up, the final push up, which is a bearish candle. So the last red candle is our mitigation candle. So that's how the mitigation block looks like. So it is something like this. I mean, the bearish and mitigation block, price moves up, price comes down, then pushes up. So the red candle here, the last red candle here, forms our mitigation candle. So after that candle is formed, price pushes up. How you know its mitigation is the high here will not be as high as the high here. So price comes to this region, breaks this region that was held as support. So the first green candle that was here, or the last red candle, as the case may be, before the push up that refused to get to this high, forming a lower high. So price breaks through here, comes here and comes back to retest this region, and price now moves away. So that's the bearish mitigation block. Now the bullish counterpart is just the opposite. Price is coming down this way, price moves up, pushes up, price pushes down, but doesn't get lower than, doesn't get to the low of this previous low. Price pushes up, breaks the previous resistance, and price now comes back to test that resistance, then pushes up. And that's how your bullish mitigation block looks like. So those are the two types of mitigation block that you can have. You have the bullish mitigation block and the bearish mitigation block. So I'm going to explain. So after that explanation, let's quickly go to the chart. So let us look at this chart here before us. We have our EUR GBP. So let's look at that's 17th of July 2023. Let's look at this chart. Price went up here. After price went up, price came down. When price came down, like I said, the green candle just before price goes up is our bearish mitigation block. So I'll put that notice here. So on that green candle, I mean the green candle here. So what do you observe? Price pushed up. So when price pushed up, this high, look at the value, 0.871 0.87019 is not as, is higher than this I, which is 0.86982. So because of that push down, which is at that cycle, that is the push down here, look at how price got lower, that is in value. Let me use the brush to indicate here, price got lower, and you observe price eventually broke through this last green candle with this red candle, and price came back to retest at this region. And this whole formation here is what we call bearish mitigation block. So let us quickly look at the bullish counterpart. Now for the bullish counterpart, we have for the bullish counterpart, like I explained the other time, we have a push down. We have a push down here. This is a good example here. We have a push down. So I'll use my brush. We have a push down, like I said. Then we have a push up. Price breaks a particular level. which is a initial rejection, which was at this region here. So when price breaks it, price comes back to retest that region and now moves back up, and that gives us bullish mitigation block. So the last the last rejection candle, which is around this region, that got broken and came back to test and holding as support, is our bullish mitigation block. So I'm going to draw now. So we have a downtrend. So we have the last candle. Yeah, the rejection candle here. That's this candle here that got broken. So the push down, like that's the first criteria. Now this forms a higher high here. There's a high here. There is a higher high. Price broke above this initial rejection, which is at the top here. So having price breaking above, when I say the rejection, I'm talking about this top, that's this region here. So price broke above that rejection. So price came back to that region. So the region between here and here is called the bullish mitigation block, which looks exactly like what I explained. Price is in a downtrend here. Price forms a higher high here. Price breaks beyond this place. Price comes back to check here. Then price moves up, and that's the bullish mitigation block. So I hope I've been able to explain this in simple terms, the bullish and the bearish mitigation block. It is pretty simple. And it is pretty simple to identify. They don't happen in the market all the time, but anytime they happen, they always play out. So these are the conditions for bearish and bullish mitigation block. Thank you for subscribing. Don't forget to subscribe to my channel. I hope to see you in another video.